Hi everyone, I'm Aman from the investment team at Syfe. I'm here today with Dr. Apollo Lupescu from Dimensional Fund Advisors, one of the pioneers in evidence-based investing. Dimensional has been at the forefront of turning decades of academic research into practical real-world investment strategies. And today we're going to talk about how those same principles have influenced how we've built our Syfe Core portfolios. Now, I've never worked at Dimensional myself, but earlier in my career, I actually helped build some of the trading strategies they use to execute. So I've seen firsthand just how thoughtful and precise their approach really is. At Syfe, our core portfolios are designed to be systematic, globally diversified, and built on the same kind of academic foundation that firms like Dimensional have championed for decades. This conversation matters because we want to help investors build long-term wealth by staying invested and avoiding some of the most common mistakes, like trying to time the market or chasing the latest hot stocks. And ultimately, we want to show you the why behind Syfe Core, why it's built the way it is, and how those design decisions are made to give you the best chance of long-term success. Could you tell us a little more about Dimensional Fund Advisors?
Well, first of all, thank you so much for the invitation to be part of this recording. And also, thank you so much for inviting us to be part of your portfolios and the trust that you've had with us. Dimensional Fund Advisors is an investment manager based in the US. Currently, we manage anywhere between 750 or 800 billion US dollars, depending on the market every day. And we have been doing this for over 40 years. Our expertise is in both the public stocks as well as bonds, and the client base is typically institutional in nature, either large corporations, investment funds, or certain financial advisors. And I think what's interesting about Dimensional is that we have a very academic, scientific approach to investing. Over the past 40 years, we have had 5 different Nobel winners who have been directly involved in the funds and development of the strategies. And we are considered right now probably the most successful cross-fertilization between the scientific, rigorous research and the practical world of investing. And because of that, the strategies that we have are quite distinct from what you typically see out there, which is either stock picking, traditionally called active management, or on the other side, index management. And we're somewhere in between. We're in the middle ground where we're trying to outperform, but without the traditional way of picking stocks or timing the market.
Understood. And so today we're going to talk about Syfe's core portfolios and the thinking behind how we build those. And it's very much in line with Dimensional's approach. I can speak firsthand helping build some of the trading strategies which Dimensional used to execute, and I can vouch for the precision and care and attention that is taken in every detail.
Yeah, and we've been doing this for so long, and I think it's gotten better. It's incrementally gotten better. We learned, and working with partners like you, we kind of, how do we step up our game? And over 40 plus years, we've just gotten better and better. It's a lot of experience embedded in those 40 years.
And so the importance of today's conversation is to help our clients understand about how the Syfe Core portfolios help build long-term wealth, making systematic, disciplined decisions over the long term.
Yeah, which I think is really important because everything in life, including investing, changes. There's an evolution in everything, and investment strategies have also evolved. And I think that what you're trying to do is really make sure that whatever you offer to your clients, it is state of the art. Not what used to be state of the art, but what is currently state of the art.
Now let's talk about stocks and performance. You mentioned their stock picking. Why do I need a Syfe portfolio at all? Why can't I just pick stocks?
Yeah, and I think stock picking, the way it's been known, kind of goes back about 100 years to Benjamin Graham, who was an investor in the US. And he had this realization that when you pick a stock, it shouldn't be based on a hunch, or because your cousin told you or a friend said you should buy that, but rather do some level of research. So what Benjamin Graham did was try to look at is it a good deal to buy the stock based on what I expect to produce down the road? And in that respect, that gave birth to statistical analysis of stocks. And the name of the game has always been information. If you can get the information faster than other people, if you can get better information, and if you can process it in a superior way, well, that ought to give you as an investor a competitive edge. And that's what Benjamin Graham was really kind of getting at. Like, let's find a way to get a competitive edge in the market by analyzing information better, by getting the information sooner than other people, and then by having availability that perhaps others don't. And I think for many years, there was something that you can cling to. There was maybe reasonable to expect that some managers or some investors can get better information, can get it faster, or they can analyze it in a superior way. And I do believe that maybe there was a time when that was possible. But what I've seen over the past 20 years or so is that investing has completely transformed, because today information travels incredibly fast. Everybody has access to the same information, and it's not legal to trade on something that you shouldn't know. And then, thirdly, it is so hyper competitive that in the US, there are more professionally managed funds than actual stocks trading on the market. So today, doing that analysis, the question is, can you get a competitive edge in a world when information travels so fast, when everybody has that information, and it's incredibly competitive? And what the data seems to suggest is that the world has changed, where this idea of picking stocks no longer is what it used to be. And the way that it manifests is that if you analyze the performance of managers who are trying to do this, and you see, well, what's the evidence? How good are they at analyzing? How good are these professionals? Spend hours looking through the books. They go to Harvard MBAs and Stanford PhDs, and they're just the smartest in the world. How good are they at picking stocks, given there's a lot of money they can make out of that? And the evidence is not encouraging. If you look at 10 years, for example, for a manager, and you go back to the end of 2024, and then again, look back 10 years, what's fascinating is that about a third of the managers don't even survive the 10 years. In fact, they just close shop. The funds disappear. And out of the ones that actually survive, only about 1 in 4 outperform. So think about this, 3 in 4 underperform the market because they have their fees and it costs money to do the analysis. And by the time it's all said and done, you're just not outperforming. The vast majority are not. And giving them more time doesn't seem to lead to any better results. In fact, it's exactly the opposite. If you look at 15 years, it's only 1 in 5 that outperform, meaning that 4 in 5 do worse than their benchmark, and only about half of them survive. And if you really look at 20 years, which is a more realistic time horizon for a manager, it's less than fewer than 1 in 5 outperform, 18%, meaning that 82% underperform. So your chances looking at managers today is that you will pick somebody underperforming. And that has been the impetus for a big change in the industry. Stock picking is not what it used to be. And, not to say that it was a bad idea. I think when I grew up, when my kids were growing up, actually, more like my kids than myself, there used to be a store called Blockbuster Video. I'm not sure if you remember those, the good old days.
I do.
And you get a VHS tape. Get the VHS tape, you put in the VCR, you go pay the late fees, get another one. That made sense in the 90s and maybe the early 2000s. But once internet streaming came along and Netflix and Hulu and Disney Plus and all the other streaming channels, having a VHS tape is no longer what it used to be. And to me, stock picking is a bit like Blockbuster Video in the age of Netflix. It made sense at some point, but not today. There's no evidence to suggest that it's worth doing it, and there's no evidence to suggest that it's going to come back, that somehow it's got legs for the future. It's a thing of the past. And there's a great hockey player, Wayne Gretzky, and he has one of my favorite sayings that what made me successful is that I chase the puck not where it used to go, but where it's going next. And I think that's a lesson for investors. Don't chase something that is past its prime.
So if investors were to try and pick, say, stocks that they think are going to go well, is there a downside to that?
There are pluses and minuses. The plus is that you could hit some winners, and you can absolutely do that. The negative is that the same winners might not repeat. And just let me give an example. In the US, we have this metric of the market called the S&P 500. And if you look for the first quarter of 2025, the performance in US dollars for the S&P 500, what you see is that it was down about 4%. And how do we measure this? How do we get to the 4%? Also really important for investors to know is that you measure the performance of 500 different stocks. And that's one thing that you're looking at. But the other thing that you're looking at is what is the size of the company? Size meaning how many shares of ownership and how much is each share worth it. And that gives you the market capitalization, the business value of that stock. And the way we measure performance as investors is not looking only at the performance of the stocks, but also how big is that company? How much emphasis do I put on it? And the way that you measure performance is by assigning a greater weight, a greater percentage, a greater emphasis to the larger stocks. And in the US, these large stocks, they're called the Magnificent Seven. And they're companies that you probably know about. There's Microsoft, there's Apple, there's Nvidia, Google, Amazon, Facebook, and Tesla. And these seven stocks have been actually doing, they've been gotten a nickname. First of all, when you get a nickname, because you're doing something well. And what's fascinating is that if you take these seven stocks apart, you can look at last year in 2024. And what's fascinating is that on average in 2024, these stocks were up about 60% up. And that's what a lot of people said, boy, let's me go get more of these stocks because they're doing so well. But again, the more you concentrate, you can make a lot of money, but you have to be ready for the flip side. Because this year, the same exact seven stocks that were flying so high, they are down about 15% on average between the seven of them. Again, the market as a whole was down about 4%. They're down 15%.
So a lot more.
A lot more. And if you look at the remaining stocks in the S&P, so let's just call that S&P 500 minus the 7, so the S&P 493, they're down by less than 3%. So I think that the important lesson is that when you concentrate, you tend to hit more extreme returns. And you can go on the positive side, but it can also be on the negative side. And Aman, what's so interesting that people need to understand is that when you concentrate it, and the reason that these stocks have such a big impact on the S&P 500 is because in the S&P, these seven stocks together, when you add them, they amount to roughly 30%. 30% of the value of the S&P. 30% of the performance of the S&P is attributable to seven stocks. That's quite a bit, like a big chunk of the performance in a way. To me, like that's pretty decent.
Yeah.
And what's fascinating, Aman, is not as much as NASDAQ, because the same seven stocks are also part of the NASDAQ index, but not at 30%, but rather at 52%. More than half of NASDAQ comes from seven stocks. So last year when they're flying high, well, guess what looked phenomenally good? NASDAQ. This year that they're not doing so well, guess what looks really poor? NASDAQ. And so I have to caution folks, if you choose to concentrate and try to pick these stocks, you tend to hit more extreme returns. Now, if you have these stocks, not only part of the S&P or NASDAQ, but a global opportunity set, which is what we encourage investors to consider, the same exact seven stocks will be part of that metric, in this case called MSCI, but the percentage of them is only about 20.
Right.
So it's you're not missing out. You're just not concentrating as much. So I think one of the big things that has happened over the past few years is investors realizing that I want to participate in the success of these companies. I just don't want to overdo it, because the more I expose myself to a handful of stocks, I can make a lot of money, but I can certainly lose a lot of money. And that's really dangerous. And that's why when we encourage folks to really have a global perspective to investing, not miss out, have these stocks, but make sure that there are others in which you partake, just in case they don't work out, and avoid these extreme outcomes.
Yeah, I agree. I think diversification is such a key point here. It's something we employ across our Syfe Core portfolios. In fact, the same statistic, the weighting of the Magnificent Seven in our core equity 100 portfolio is just 13%. We're very conscious of just how concentrated these other indices are. And I think it's important our clients understand that.
And it's paying off for them this year. It's paying off. I mean, I think that, it's something that over the long run, it's clearly going to benefit because it avoids these extreme outcomes. And they are so dangerous, Aman, because let's just take a simple example. If you started a year with $100 and you lost 50%, which is pretty much what these 7 stocks did in 2022. So if you start with $100 and then you lose 50%, by the end of the year, you only have $50. And now you start the following year, let's say 2023, with $50, and you want to go back up to where you were at 100. Well, to go from 50 to 100, you now have to double. In other words, go up by 100%. So if you drop 50% on the way down, on the way up, it has to be 100%. And that's why these outcomes, the extreme outcomes, are so dangerous. Because even if you see a great year when they went up by 100%, all they're doing is catching up. You want to avoid extreme outcomes. I think that's a really key ingredient of a successful investment experience.
That sounds very important. What do we mean when we talk about geographical diversification then?
Yeah. And I think it's important to know that geographical diversification doesn't mean that you're investing in a country. You're not investing in any one country. What you're doing is you're investing in companies, and companies can be based anywhere. And you just don't want to limit yourself to just one region. And in fact, if you look at companies and where they trade and you redraw a world map, not based on landmass, but rather the value of all companies that you can buy and sell in any one part of the world, it's quite fascinating what you find. The US economy is pretty big. It's about a quarter of the value of all the economies in the world. But the stock market in the US is about 65%. The 3,000 plus companies that you can buy in the US together, Apple, Google, Microsoft, McDonald's, Coca-Cola, all these companies in the US on stock exchanges amount to 65% of the value of all companies that you can buy as an investor. So, an important starting point would be, well, if I want to buy US stocks, how much money do I want to put in there? And this map, this what's called world market cap allocation, it kind of gives you a starting point. You see, the next largest stock market would be Japan. But Japan, it's only 5%. It's less than a tenth of the value of the US market. So it gives advisors like you and investment managers like you a primer onto how do I allocate among different countries. And I do think it's important to keep an open mind across countries because sometimes people say, why not just put money in the US, buy just US stocks? You could do that. And, if you take a simple example with cars, what it would mean is that you want to buy shares of ownership in companies like Ford, GM, and Tesla, and they're great American car companies. You probably can see them in Singapore, anywhere you go in Asia, there'll be some of these cars. Now, if you also look on the streets, you don't only see these American cars. You also see some BMWs, Mercedes, Porsches, and those are brands owned by German companies that trade in Germany. Even Jeep and Chrysler, they're all famous American companies. Those brands are owned by an Italian company, Stellantis, that trades in Milan. That's Italian investing. You're familiar with Honda, Toyota, all the Japanese car companies. And ironically, even great British brands are not owned by an Indian company. So you have to go to India to buy Land Rover or Jaguar. Volvo, my daughter drives a Volvo, and that company is owned by a Chinese company, Geely. And then you have the Korean shops who are also making inroads. So ultimately, what we're suggesting, if it's worth considering Ford and GM, why not look at BMW, Toyota, and Jeep for that matter? Because that is global opportunity, a global opportunity set. That's global investing. You're familiar with these brands. You're not buying something exotic. Again, and you are investing in companies, not countries.
Now, diversification is something key to Syfe's core portfolios, and we incorporate it into each of them. Another investing phenomenon that we rely on is factor-based investing. Right. Now, I think there's no one better place to walk us through that. Could you give us a simple overview of what is factor-based investing? What are factors?
Yeah. So to summarize, what we discussed so far is that today's modern investor wants to participate in the global productive set. And you should own as many companies around the world as possible. Let's start with that point, that you want to own as much of the global productive capacity as you can, and that's what your portfolios do. And once you decide that, the second thing is that you want to look at country by country and decide how much you want to put in each country. The third step afterwards is say, well, within each country, how much should I buy out of each stock? And it turns out there is some really rigorous scientific research going back to the 1980s that delineate between different categories of investments and what's become known as asset class investing, which simply says these are stocks that have similar characteristics. And in the US, if you go back again to the 1980s, what the research found is that if, let's say, the square represents all the stocks in the US market, the first delineation that he can make is based on the size of the company. And you have some very large, well-established, mature companies called large caps or large companies. And this is what you typically see in the S&P 500, these very large, well-established stocks. But in the US, there are also about 2,000 other smaller companies that are not part of the S&P. And those are called small caps or small companies. And just to illustrate, I mean, here in Singapore, you certainly have McDonald's, and that is an example of a S&P stock, large, well-established, mature. And the example of a small company is another publicly traded stock called Shake Shack. And you probably have some Shake Shacks right here on the island. And Shake Shack is a publicly traded stock. They sell burgers and fries like McDonald's. But if you think of the economics of these two companies, I can see Shake Shack growing and perhaps doubling in size easier than McDonald's. So small caps typically have more room to grow. On the other hand, the large companies have a longer track record. They're a little bit more mature, and investors might consider them less uncertain than the smaller ones. So economically, you see there are some differences. And how they manifest as returns for investors is something that you and I are very familiar with. This book. It's called The Matrix book. It's one of my favorite books of data and numbers. I'm sure that if anybody would like to get the numbers, you can share the full set of numbers. But here where it gets interesting, we have data going back to the 1920s in the U.S. So I'm gonna show you the U.S. dollars because I'm much more familiar with that data. It's the longest in the world. And if you go back to 1920s, and if you had invested a single dollar, not 10 or 100, a single dollar in the S&P 500 over the long run, what you see is that the growth of that dollar would have been roughly around $14,000. So $1 grows to about 14,000 fold, which is a really phenomenal, if you think about it, that's a big growth. Now, if you had invested the same dollar in the small companies, so the companies that are not in the S&P, but they're still part of the stock market in the US, and kept it invested without touching it, and every year you kind of go and redraw the lines, and every quarter, like what exactly is a small versus large, the same exact dollar over the same time period, if you look in the Matrix book and the dimensional small cap index in the US, the same dollar would have grown almost to 49,000, but let's just say $48,000 over the course of 90 years or so. So a much higher growth if you think about small companies. So you can delineate based on that. And then in the 1980s, the question was, what about all the large and what about all the small? Are they exactly the same? And a new delineation came based on the price at which you buy a stock. And this is the price relative to some accounting fundamental. And the lower price stocks, they are called value companies. And over the long run, they outperform the more expensive counterparts called growth. So if you knew that small beats large, value outperform growth over the long run, then obviously the one part of the market that ought to give you the biggest bang for the buck over the long run is small and value. And if you look at the Matrix book, that dimensional small cap value index, what you would see that the growth of the same dollar, same time period, would be over $152,000. So quite significantly more. So that adds another layer. So the first layer was like, we want to own the global productive capacity, buy as many stocks around the world as possible. That's the first layer. The second one is assign different percentages to different countries based on the value of stocks in each country. And the third layer that we're suggesting here is that within each country, it's up to you as an investor to choose whether you keep it in the natural market capitalization weights and you buy each company in the percentage of the market there, or if you choose to emphasize small companies and value stocks. And the more you reshuffle the deck and you emphasize small and value, the more you give yourself an opportunity to have a higher return over the long run. And that's something that you work with your clients, and you decide how much do we want to reshuffle this deck, or how close do we want to stay to what's called the natural weights. But that's a really important decision that you make when you do your research and figure out for your clients what's appropriate.
Absolutely. And I think a natural question from a client might be, okay, so over the long term, small and value, and in particular small value stocks, are going to get me outperformance over the long term. Why do I not just only hold those stocks?
Yeah, absolutely. What's the catch here? I mean, because it seems like why not put all the money in what grows the most? What's interesting about this is that there is no right answer. What we tell investors is that medicine, investing, everyday life is not about certainty or guarantees. These numbers are rock solid. What you need to know is that even if you're looking at something that seems obvious, like for example, working out or eating healthier, that improves your odds of having a healthier, longer life, but it doesn't guarantee you one. And it's the same here. This is statistics and probabilities. What you want to understand is like, how likely is it for me to see this? And this is where it gets interesting, because if you look not at a quarter, you look at an entire year, what you see is that value companies, value stocks have beaten growth about 60% of the time on a 1-year basis. So even if you have a 1 year, 60% of the time value beats growth. So even if you had 1 year and you ask, well, which one should I emphasize? Well, emphasize the one that outperforms, value in this case. Now you can think about the other way. 4 and 10 years is not there. And you can go through that period and see, well, it's been a year and I don't see value beating growth. What's wrong with the strategy? Nothing. I expect that to happen the same way that, in life, again, you have the odds. Now, if you give this strategy more time and you go to 5 years, the odds improve to about 70%. So you're now at 69, 70%, which is, again, it's a better probability. Is there a guarantee? No. 30% of the time or so, it's still not there. But if you see these odds, kind of begs the question, what part of the market would I emphasize, given that I know I might run into a 30% chance of not seeing it? And that's why this strategy requires an advisor who really has done their homework and can maintain the discipline. Because over and over, we see investors basically bailing out. Oh, it's been 5 years. I'm not seeing this. Something must go wrong. Nothing goes wrong. I expect that to happen. The same way that if you quit smoking, it doesn't mean that you might not develop some lung issue. It doesn't mean that you're going to live forever. No, you're a lot better off if you stick with the program than say, well, I've given it some time, that doesn't work. So to me, even if you give it 10 years, you're still going to have better odds. And the more you give time, it's still not going to be 100%. So this is all about odds, statistics, and probabilities. And because there are times when growth beats value, then it is good to have growth as well and not just go all in into one investment class.
And that's where our portfolios come into play, ensuring that discipline and that long-term focus. And I think that's really important for clients to understand.
And I think that what gets me so excited to be here today is that in the US, we've seen a group of advisors really embrace this much more institutional, much more scientific approach, and be able to, basically be a coach for their clients and help them, guide them through all these market cycles. And to see that in other parts of the world, this is not only gaining traction, but really advisors are becoming extremely successful by doing the right thing for their clients is incredibly satisfying, because it is becoming more and more mainstream in the US. And we are seeing it kind of, emerging around the world. And at this moment, very few advisors have done the homework that you've done, the research that you've done. And it's incredibly gratifying to be on this webcast and talk about these things, because again, not many advisors have done the homework and put in the work that you have done.
Thanks. No, it's great to be part of the movement. For us, yeah. The devil is...
It's a movement, yeah.
Now, zooming out, how can we think about other asset classes? We've talked about stocks. How should we be thinking about the other asset classes in terms of managing the risk of our portfolio?
That's a great question because so far we've talked about stocks, as you said, and stocks basically mean that you own a piece of a company. So stocks are about ownership. And you might have not started Microsoft or Tesla or you name it. And somehow you can participate in the ownership and partake in the earnings of those companies, which I think is an amazing thing. It gives us all a stake in capitalism and free markets and in the success of companies that we use every day. So I think stock investing is phenomenal and it's driven by this idea of ownership and profits that companies are expected to make down the road. And that's where the value of a stock, that's where the price of a stock comes from. Now, as we know, no business is guaranteed success. There are fluctuations in earnings and profits, and that's why you see fluctuations in the stock market. So you are buying quite a bit of uncertainty in the stock market, and you should embrace it because it's totally fine to be there. There's nothing wrong with that. People sometimes don't want that. They're like, I'm close to retirement. I don't have the stomach for that. My risk capacity is low. So what else can I do with my money? And it turns out if you don't want to buy ownership, there's an alternative, and that is lending your money. Turns out that the US government, companies, maybe the Singaporean government, they want to borrow money. They need to borrow money, and they are willing to write up a contract. And in that contract to specify an interest rate, for how long you get the interest rate, and at the back end, you get your money back, the principal back. That form of lending is called bonds. So as opposed to the ownership in stocks, you can lend your money in bonds. And the beautiful thing about bonds is that there's a contract that tells you exactly what interest rate do you make on your money. And global bonds is pretty much like stocks, is not limited to the US. In fact, if you redraw that map that I mentioned earlier, not for stocks, but for bonds, it gets quite interesting because when you look at bonds, there is a global opportunity set. And in that set, the US is not 65%, but it's rather about 40% of the value of all bonds that are available to investors. And Japan and China are now a lot bigger players. And you look at the Japanese, for example, most of the bonds are issued by the government. In other words, the government borrows the money. In the US, it's a much greater balance because you have companies who want to borrow money in this way, and there are different interest rates based on how risky they are. So bonds are a huge opportunity. And the benefit, again, is that they don't fluctuate in value as much. And that's what investors tend to like. Now, there's a trade-off. And certainly all there's a trade-off. We mentioned over the long run, you can invest money in the S&P, and $1 since the 20s grows to $14,000. If you had invested the same dollar in what's considered to be one of the safer bonds issued by the U.S. government, so you enter into a contract with the U.S. government, and after 30 days, you get interest and your money back. So it's very short term. It's the U.S. government, never missed an interest payment or a principal repayment. So relatively, nobody can say, hey, that's a high risk investment, very low risk. Over the long run, in these investments that are called the 30-day U.S. Treasury bills, there has never been a single calendar year in the U.S. Treasury bill 30-day index where you would have lost money. Not a single negative year. So you kind of have a confidence that, hey, data shows that it's a relatively safer investment to stocks. It doesn't fluctuate as much, never a negative calendar year, but there's a trade-off. You're not going to make $14,000. How much are you going to make? The same dollar, same time period would have grown to roughly about $23. A very different outcome. So you can have stability, but there's a trade-off. And that is the fundamental trade-off in investing, stability versus growth. And I have to say, there is no right mix. So there is no right mix. As I said, there is trade-off, stability versus growth. Now, these bonds, they're not all like 30 days. You can lend the money to the government for a longer time. So if you look at longer term bonds, instead of $23, the same dollar would have grown to about $109, which is certainly more than T-bills, but nothing compared to stocks. Because if you look at stocks, that would have been about 11,000. This is because we started rather in the 20s, like in my Trooks book, it starts a couple of years later in the late 20s, since we have good data. But still a very big difference in the growth of stocks versus bonds. And then you can look at small and you can look at small value, and you see that as an investor, you now have a primer. And this is what advisors do. They have a primer. I have not only the idea of global productive capacity, but there's a way to control risk and uncertainty by using bonds. And how you mix that, that's the art and the science of investing. And I know that's what you do for your clients. And the big, and again, I can't come back to this. You have to understand what you're getting into. Because when I'm showing you that small value shut the lights out compared to T-bills, your expectation will be that every day I'm going to see that. That's what I expect too. It just turns out that I also know that's not always the case. And if you look, for example, over the past 15 years or so, year by year, to see what investment category out of the 5 that I just showed you does the best, well, you would see that these 1 month treasury bills, they outperformed 3 times. Bonds, longer term bonds, they outperformed twice, about 5, of the years. The best performing investment in that particular year was a bond, even though there's such a vastly different performance. So you have to be aware that this is not going to be the case every single year. I expect that's going to be the case over the long run. And if you have an investment portfolio that combines these bonds, these stocks, small value, you have so many moving pieces that you're ultimately going to have the best performer as well as the worst performing asset class in the world.
And this, I think, is something really important to us at Syfe, and it's why our core portfolios, there are actually 4 portfolios. We have our core equity 100, which is an 100% equity portfolio, but we have core growth, balanced, and defensive, which include bonds and gold as well as a safe haven commodity, which really balances out those portfolios over the longer term.
That's really, really smart. I mean, I think that's the way to do it. And that's really the way to do it. And at that point, once you have the portfolios, I mean, I'm sure we can spend a whole day thinking about how do you keep those portfolios in balance and how do you adjust as things change, because things do change and you have to make adjustments. And I think you start with the right idea. Let's look at what matters. We have stocks, bonds, gold. Let's mix in different proportions based on what somebody's risk capacity or needs might be, and then kind of stick with that program and make adjustments as things change.
Exactly. I mean, we rebalance twice a year to ensure that those asset class mixes are reasonably stable, so that the client's outcome is constant through.
And they have, again, I mean, at that point, given what I just heard, they have exposure to 14,000 different companies in 40 different stock markets. You're never going to miss out on something. And on the other hand, not any one company is ever going to have a meaningful impact on your wealth, which is amazing. Because, my father-in-law, he happens to own one stock. And I don't actually think that he owns the stock. I think the stock owns him. Because every single day he wakes up and the first thing is like, oh my gosh, how much money I made or lost. But it's draining. It must be so terrifying to have your entire wealth in one stock. But in this approach, it doesn't really matter. If that stock goes under, I got 13,000 others. Who cares? Like none of them are going to be a meaningful enough part to really be devastating to my wealth. And so it's not only good for your financial wealth, but it's also good for your mental health.
Yeah, I think my grandfather used to write down the NAV of his portfolio each day. I think I've seen my dad checking on his portfolio most days, and I've said to him that probably he'd do better checking it less often.
That's a really smart thing.
Now let's focus on investment discipline. What should clients be thinking of in terms of their investment approach when it comes to discipline?
I think they need to start with an acknowledgement that when you invest in the stock market, I can tell you right now that there will be down periods. So manage your expectations. Don't think that markets always go up. We know that the nature of the markets is to fluctuate in value. There's nothing really tricky about that. In fact, if you redraw the timeline of the S&P 500 in the US, going back to the 20s, based on bull and bear markets, what you clearly see is that bear markets, when the market drops by about 20% or so, they're not terribly unusual. They do happen. The good news is they don't happen as frequently or as long as the bull markets, and that's where the growth comes in. But you have to expect that's going to come. It's a little bit like an earthquake. I might know here that where I live in Los Angeles, there's an earthquake coming. And at the same time, that's not valuable because I don't know when. So I can tell you right now, the market's going to drop at some point. I just don't know when. And that is a key insight, is that expect that market's going to drop. There's nothing really unusual about that. And if anything, when you have some of these big drops, that might present an opportunity rather than a threat. Because we know that these things happen. You got to be ready for them. And when that opportunity presents, that's the time to do what you just mentioned a second ago, which is rebalance. So manage your expectations. And when the market drop, maybe the tongue in cheek is to say, hey, something went on sale. If you see something going on sale, you can say, no, I'm going to wait for that to come back at full price. Or when I get it now, that it's on sale. So in some way, that's not always kind of the right way to think about it. But just conceptually, if something drops in price, perhaps there is a better price that you buy it. It's an opportunity to get it rather than wait till, I'm going to wait till it goes back to where it used to be in price. So to me, that's the first thing that I would tell folks, is that you do have to look at the markets over the long run, realize that there's nothing unusual about the market dropping. And in fact, it's a sign of strength. Aman, a few weeks ago in the U.S., the new president, the administration announced tariffs, and it was, the tariffs were a little bit unexpected in their scale and breadth, and it took a lot of folks by surprise. They didn't expect it was an unexpectedly large tariff that the administration imposed. So at that point, that clearly would have had a very negative impact on companies' earnings, because it would have been harder for them to run their business and make money. If they're not going to make as much money, and this is disruptive to their business, what exactly do you expect the value of the company in the stock market to do? Stay the same or go up? No, the expectations go down. So when the market went down, to me, that is a sign of strength, because it reflected the reality. And not soon after, the reality changed, and it reflected that. So when you see market volatility, I would not say the markets are crazy. They're doing exactly what they're supposed to do, which is reflecting the new information about the potential for companies to make money. And what's interesting is that if you go back 30 plus years, there was always a moment in time when the market, the S&P 500, was down at some point. It was down at some point. There was never a year when the market was always up. And sometimes these drops were quite significant. What's interesting is there was also a moment in time, even in terrible years, when the market, like 2008, the market was down quite a bit. It was down about 30+% in the US and the S&P. And yet there was a moment in time when the market was up that year. So within a year, you can see the wild swings in what the market does, the largest intra-year gain, the largest intra-year loss. And the question is, how much does it matter when it comes to the ultimate outcome for the year? And take the pandemic. It's a good illustration, because during the pandemic in 2020, there was a moment in time, in probably a few weeks, where the market had dropped by about 34%, lost a third of its value. So an investor panic is like, whoa, this is not good. We're all stuck at home, and market lost 34%. In the same year, in 2020, there was a moment in time when the market was up about 70%. 70%. So the largest point was up 70% for the year, lowest negative 34. That's a huge spread. And where the market ended up was positive 18%. Again, this says nothing. In fact, if you go back through all this time frame and you look at the largest intra gain, the largest loss, and where the market ended up, there is no pattern. It doesn't say anything. The fact that the market dropped so much or that went up, that means nothing. So that's the second point that I want to make to investors, is that, first of all, expect volatility, and that is a show of strength for the market, not a weakness. Number two is that within a certain year, you can have a huge divergence. And number three, you really ought to pay attention to the market and give it some time to work for you. Because if you try too hard, it might actually be detrimental. Maybe I'll kind of share a story. A while ago, I was asked by an advisor like you in the U.S. To go present to a group of retirees in Northern California. And she had some of those clients coming from the retirement community, and they said, well, we have an investment club. And they would like to have an investment manager come and talk to them about what the market's doing, where it's going, and what they should do with the money. And I wanted to get more details on that investment club. And it turns out that they would wake up, they would have breakfast, watch the market every single day. And then when the market closed, they would go play tennis. Those are the activities that they did over and over again. And I was trying to share with them that, because what they wanted me to tell is like what the market's going to do. And I was trying to share something with them that would be kind of reassuring that this is not necessarily the right thing to do. Watching CNBC and Squawk Box and Bloomberg, and I don't want to pick on any one channel, but generally speaking, and trying to infer something, it's not productive. So here are some statistics that kind of help those folks kind of understand a little bit, what does it mean to give the market time to work for you? If you look at the S&P 500, and whether it's in 2024 or the last 50 years, it's remarkably similar on a daily basis. If you watch the market any given day, what you see is that 53% of all trading days in the market are positive and 47% are negative. Meaning that if you watch the market daily, it's a bit of a flip of a coin if you make or lose money. There's no clarity, oh, I'm going to make money. No, it's just not clear at all. Now, that's why half the days are depressed and half the days that are springing their step, because that's what you get if you watch the market daily. Now, if they had waited for the quarterly statements, and you look at the data over the past 50 years at the S&P on a quarterly basis, not daily, what's fascinating, Aman, is that instead of seeing these percentages, what you see is that about 71% of the quarters have been positive and only 29% negative. So simply switching your time horizon, letting the market work for you from daily to quarterly, you are a lot more likely to see a positive outcome. A lot more likely. And all you have to do is just give the market a little bit of time to work for you.
Makes sense.
Makes sense. But a lot of people are so hyper focused on, oh, look, the market dropped this year, or this week, or you have to give the market some time. But it's also interesting that if you decide I want to get out because things don't look good, you have to acknowledge that you could miss a bad quarter. But what is it more likely for you to miss? It's a positive quarter. If you get out of the market, it's as if you play a game where you stand to lose 71% of the time. That's not, you will never know the sands and the marina to go play those games. It'd be silly. But why would you do that with your money in the market? Because you're a lot more likely to miss a positive quarter than a negative. And if you give it the whole year, if you're patient enough for the annual statement, what you see is that on an annual basis over the past 50 years, the S&P 500 was up about 78% of the years and only down 22%. So big difference in even on a quarterly basis from quarterly to annual. And I wanted to somehow connect this with the other hobby they had, which is tennis. So I ended up kind of digging up some statistics on a player that had just retired. And I did like watching him. I thought he was a class act. His name is Roger Federer. Arguably the all-time best male player. And I say arguably because even people on this call might have a different opinion.
I'm with you.
Yeah. But I was curious, how do you get to become a champion? And he's not an average player, he's the best of all times. And if you look at his statistics, what you see is quite remarkable, is that in his career, Roger Federer won about 54% of the points that he played. Meaning the best male player of all times, arguably, lost roughly half the points that he played. And he was the best of all times. In other words, to be the best of all times, you don't need to win 90%. You just need to win a little bit over half. And that's what he did. But what Roger did, he stuck in there, played all the points, won the big ones. And if you give him more time and you ask, well, okay, I'll wait for the whole set. What you see is that if you give him some time, he won roughly about 75% of the sets that he played. And if you really are patient enough for the whole game, you see that he won about 81% of the matches. And that's what we're talking about. That's the same with the market. If the market drops any one day, don't be panicked any more than Roger Federer losing a point. Oh, I'm going to pack my bags. He lost the point, is done. No, we know that he loses roughly half the points, the same way that roughly half the times you're not going to make money in the market. But the more time you give Roger, the more time you give the market to work for you, the more likely it is for you to see a positive outcome. And I think that's a really key ingredient of a successful investment experience is just don't get carried away with the short term, because we know the markets are very, very choppy, particularly on the short term basis. And the more time you give them to work for you, the more likely it is for you to see a positive outcome. Pretty much like with Roger as well.
No, I love this stat on Roger. I'm a keen paddle player, and I have learned the hard way that consistency trumps sometimes moments of brilliance, although I dare say he has had many more moments of brilliance than I have. We won't go into my window.
But he also had moments where like, what am I doing here? I'm putting on the ball in the net all the time. So, that's part of the game. That's part of it. Not investing is not a game, but that's part of the process. Mm-hmm. It's part of the process. You have to acknowledge there are going to be some brilliant days. The market's going to have some brilliant days, and they're going to have some crappy days. It's fine. That's just par for the course. That's exactly what I would expect to happen. Nothing unusual.
So patience, stay invested, take a long-term approach. Manage
your expectations. Acknowledge there are going to be days like this.
Makes a lot of sense.
Like this meaning like not super happy days.
So we've talked about a lot of different things, asset classes, factors, diversification. Mm. When we think about building our portfolios at Syfe, we're combining all of these to ensure that our clients are getting a systematic, data-driven investment approach. Now, when we think about investing for the longer term, how would you advise clients, or what would your thoughts be for them in terms of when they should invest?
Yeah, I think it's the very first and most important part of a successful investment experience, in my opinion, is to start by understanding what are you trying to accomplish with your money. That's key, because if you don't know what you're trying to accomplish with your money, you'll never know if you're on track or not. It's like you can have the nicest private jet, amazing private jet. Oh, I have the private jet. If you fly from Changi and you don't know where you're going, you're going to crash somewhere. The first thing you need to plan, where am I going? And that's why the role of the advisor cannot be understated. You need to have an advisor who sits down, identifies your needs, when you need the money, how much money do you need, what is your risk capacity, what are assets you have, do you have a pension or not? All these things are hugely important. And then you develop a plan. And when you develop that plan, what's fascinating, Aman, is that in some cases, the plan might call for certain families to have a lot of money in bonds. Mm. And if you have a lot of money in bonds, then stocks are not going to be such a big deal for you. If, let's say, I don't know exactly the percentage for the conservative portfolio, but I imagine it's significantly more in bonds than in stocks. So if you're in one of those portfolios, you really don't have to worry as much about how the stock market does than an investor. And furthermore, I think that if you have a global approach, then when do I invest? Okay, here's a second layer to it, which is, do you mean the US market, the Singaporean market, the Japanese market, the Australian market, the French market? Because, they're all different. So to try to gauge when do I put money in each one of them, it becomes not really a productive exercise. So to answer your first question, my first point is that it depends. You have to have a financial plan. That is the most important element. The second is you have to define what it means to be successful in investing. And what I found to have happened over the past 10, 15 years is that in the US, there is a redefining of investment success. That it used to be, how did I do relative to a yardstick, like the US market or the S&P or NASDAQ. So you put a yardstick, you compare your portfolio results with that, and you kind of say that was good or not good. I'm not sure that's the most insightful way to determine what's going on with your money, because over the past 10, 15 years, instead of using that, how did I do relative to a yardstick mentality, the new one is, how am I on track to meet my goals? And that's a different metric, because if you have a financial plan, that financial plan typically accounts for the fact that there are going to be times when the market drops, and yet you can still be on track. You still can be absolutely on track even if the market drops. And if you think that way, then even if the market drops, it's a good time to be invested, as long as based on that financial plan. But it takes a bit of the mindset of looking at investing differently. It's not about how did I do? Do I have the winning stock and made so much money? That's it, not it. And the third one, which is crucial, is that over and over, I find that decisions that investors make are not based on deep research. They're not based on data and all that. It is based on emotions. And there are two big emotions that I see over and over. The first one is fear and anxiety. When the market drops, when something happens, an announcement is made, there's always something going on. And that anxiety can cause people to feel like, I don't need to be invested right now. It's not the right thing. And I see that that's real for a lot of people. The trouble is that if you have that fear of being invested and you get out of the market, that fear typically gets replaced with another type of anxiety, which is, when do I get back in, particularly if you had losses. So I caution folks around emotions, because emotions are big, and that even more insidious emotion is not fear, but rather fear of missing out. And look at my neighbor. He put $100 in Bitcoin, and now is like, look how wealthy he is. Why didn't I have all the money in Nvidia when he was going up so much? And that fear of missing out is real. It's absolutely real, and it's an emotion. And it's sometimes it's hard to deal with, because it's hard to see your neighbors or your friends making money. It's like, why come I'm missing out? They're telling me all the money they made. They probably don't tell you all the money they lost, but to me, those are the three key ingredients. This is the right time. First of all, have a plan, and you might not be invested as much. Number two is make sure that you, when you invest, you kind of manage your expectations and you define success. And number three, acknowledge emotions, and at the same time, disentangle them from investment decisions. And I think that's what advisors do so well, is coaching folks through these emotions that could be really detrimental to their money.
Thanks. I think that reframing is really important for investors.
Yeah.
Thank you, Apollo and Dimensional, for your broader support and being here with us today. Really enjoyed this conversation. Thank you to our clients who've joined us for this video, for tuning in. We've covered a lot, from the importance of diversification and factor investing to how Syfe Core portfolios are designed to help you stay disciplined through market ups and downs. At the heart of it, Syfe Core is built on three things: academic research, global diversification, and disciplined execution. It's about giving investors a smarter way to invest without having to time the market or manage everything yourself. The most important thing? Choose the portfolio that fits your goals and your comfort with risk, and stick with it. Because time in the market, not timing the market, is what really builds wealth. If you'd like to learn more about Syfe Core portfolios or start investing, head over to syfe.com. We hope this conversation gives you confidence in an approach that's structured, evidence-based, and built to last. Thanks again, and happy investing.